Oh my gosh, this is the post of the day on X from Heisenberg. He says stocks rally off higher inflation. Got it. Stocks rally on good news, on bad news, on okay news. It doesn't even matter anymore what the news is. It's quite incredible. Beyond that, Nvidia has officially turned into a meme stock, being up over 7% yet again today, up over 0.5% in after hours. You guessed it. On no news, no reason. At the same time, Tesla stock rallied about 4% from the low of the day to the high of the day today and closed, well, red on the day. You just can't even make this up. At the same time, Tesla stock rallied about 4% from the low today and still managed to close red. Ladies and gentlemen, welcome back to the channel. We are here to put today into context. Just how bad is this bubble in our markets and what should you expect to happen next? Also, there was surprisingly some very bullish option activity from hedge funds and institutions today in Tesla stock, and I want to discuss what I think is coming next for Tesla in the event the momentum continues in some of your big tech names, your AI stocks like Nvidia, if we start to get some downside here or kind of just trade sideways. I want to give you a rundown of my expectations bluntly around Tesla stock. I think the Kobisi letter on X puts this precisely into context. Inflation is lower than expected. Buy stocks, the Fed pivot is on the way. Number 2, inflation is as expected. Buy stocks, a soft landing is on the way. Inflation is higher than expected. Buy stocks, AI is changing the world. Even as 3 rate cuts have been removed from the forecast, the S&P 500 has already hit 16 all-time highs in 2024. The S&P 500 is currently on pace to break the record from 1995 for the most all-time highs in a single year. Which, keep in mind, Wall Street can change things, shift narratives, paint good news as bad news as good news, or however which way they want to put things. But that's why you have me, and I'm here to put things into context for you. Today was very, very, very bad news for markets. On a 3-month annualized basis, check this out. So taking the last 3 months, timesing that by 12, dividing by 3 to annualize, if we just had the same report that we got today for the next, 8 months or so, 9 months or so, what would inflation be? 6.9% in 2024. Supercore inflation, that is. So that's just your supercore. That's not even your headline CPI or what that would look like. That would obviously be higher. Core services less shelter inflation is a key metric that the Fed follows, known as supercore inflation. In January, this metric jumped by 0.7% month over month, the biggest jump since September of 2022. In February, it was up another 0.5% month over month after multiple increases in 2023. All while real wage growth is turning negative again. The fight against inflation is far from over. This is also brought to you by the Kobisi letter on X. I mean, I think one of the strangest things about all of this is it's not like the markets were selling off or super fearful heading into the CPI report. Sure, on the NASDAQ, did we sell off 1.44%, sold off 0.37%, but you're still in a very solid uptrend. It's not like we were coming off of some kind of huge fall in the markets. It's not like we were braced already or pricing in bad news. The markets continued to price in a Goldilocks picture-perfect scenario for the markets. And I think that's the problem. When you're investing, when you're thinking about are markets going to fall, are they going to go higher, you have to think about what's priced in. Now, clearly, the AI success across the board and Oracle, which reported earnings today, or Nvidia's numerous earnings reports, or SMCI's earnings, or any company, Dell, you can think of that had good, quote-unquote, AI earnings, that obviously was not priced into stocks back in October and November. A lot of people thought it was. Obviously, it wasn't. We got good earnings from them. But how much more pricing in of good news did we do since then? A lot. With Nvidia almost trading at $1,000 per share again, there's basically no way to impress investors anymore. And if anything, there's risk that the pricing in could start to go the other direction. And back to my point of what's most surprising about the CPI report, it feels like the markets are priced for good economic activity, good earnings, inflation continuing to fall. I mean, mathematically, that's what you would say with stocks trading at a 23 times trailing 12-month PE, a little bit over that after today, I'm sure, a little bit higher than that, and about a 21.5 times next year's PE numbers. I mean, aren't you priced for perfection? This CPI report today was far from perfection, and markets continued to go higher. Even though theoretically, let's just be theoretical here, right? Devil's advocate. If these guys are correct and inflation was actually good today, then why was Tesla red? Why was Fubo, interest rate sensitive name, down 4.35% today? SoFi, a company that gave you 2026 guidance that would put its PE multiple at about 8 times, which is stupid cheap for technology banking, fintech company. Why was SoFi down 2.6% in regular trading today and down almost 1% in after hours? How can you make that make sense? That makes no sense at all. If inflation was good or better than feared, wouldn't you have seen interest rate sensitive stocks outperform? Maybe I've missed something, but even back before inflation was really a problem and we got inflation reports, you would see interest rate sensitive names, small cap stocks. At the time, there was no large fears about the Fed needing to raise rates or rug pull the markets, if you will. Because, I mean, inflation hadn't spiked. I'm talking back 2017, 2018, 2016, even for that matter. All those years before the Rona, even 2020. When you got good CPI reports, inflation was low, small cap stocks would do better. For one real reason. Because if inflation is low, obviously that means the Fed's not going to need to raise rates, right? But when inflation is low, that means your future earnings on small cap companies that are these growth companies are going to be worth more. Imagine it like this. If CPI does end up running at 4% in 2024, which very well could be a possibility, we'll talk about that here in just a moment, then times that by 10, right? 4 times 10 is 40. Clearly, it's like third grade math. If you're looking at 40% inflation over 10 years, let's call it, if you're a Fubo and you're saying, hey, we're going to do 2 billion, 5 billion, whatever it is in free cash flow over the next 10 years, well, you got to shave a huge discount off of that compared to if inflation's 2% and over 10 years, there's 20% inflation. You got to, take a lot more of a discount rate on that, thus creating a lower valuation today for those growth stocks. I know it sounds complicated. It's not that complicated. Long story short, if today was truly good news for your inflation outlook, you would have seen interest rate sensitive stocks do well. You did not see that. Don't be fooled by the Wall Street guys that are literally paid to lie to you. They are paid. They are incentivized to lie to you. As soon as you start to see the markets fall in any kind of meaningful way, they're going to switch sides and they're going to say, oh man, inflation is still too high. Maybe the economy's falling apart. And then they're going to switch sides because that's what's incentivized at the time. Right now, it's incentivized to be as bullish as possible. You just had Bank of America today raise their EPS estimates for the markets to try and justify where markets are at. Bank of America says they raised their 2024 S&P 500 EPS to $250, up 12% year over year. So general consensus on Wall Street is around 10 to 11% EPS growth in 2024. They changed this from $235 per share. So that's quite an increase. Let me just kind of put this into context, what this means, or what they're saying about the S&P here. So the simplest way to figure out, kind of based on a bank's EPS estimate for the S&P, where the S&P could be or should be by the end of this year, you can take 235, their prior estimate, times that by the current forward PE multiple, or you can do trailing 12 month, but most people look at forward because what's going to happen is always a lot more important than what already happened. And if you times 235 by 21.5 times, which we're trading at for next year's earnings, that would put the S&P at a fair value of about 505 on the SPY. Today, you're trading at 516. So you're over what you would consider fair value by roughly, let's call it like 3% or so, 2% or so. Not a huge deal, but you're definitely, you can't justify where markets are at if your EPS target for 2024 is, $235. Well, let's say you just want to kind of justify why you're chasing stocks, why you're leading your clients into what could be a disaster. And we'll talk about this bubble aspect of the markets here in just a moment. But now the target's magically 250, boosted by AI drivers, AI investments. From my world, in my land, when I think about AI investments, I think about that costing companies money, not bringing in money. That's the problem right now. Tesla, you think Tesla's making money on their GPUs they're buying from NVIDIA? No, that's a drag on profitability. You think Google's making money from their GPUs they're buying from NVIDIA? No, that's a drag on profitability. You think Meta's making money from the thousands of GPUs they're buying from NVIDIA? Last I checked, the metaverse is losing like $10 billion a quarter or something crazy. No, they're losing money by investing in AI. The promise is we're investing, so we're going to make more in the future, okay? Bank of America is out of their gorge to make these kind of claims. Let's just be honest, financially irresponsible they are. But let's say 250 is the magical EPS number for 2024, times that by 21.5 times, and you're at 5,375 on the S&P. That would be the SPY equivalent to about 537 or so. Where's the SPY at right now? About 516. That would suggest maybe $15 more of upside. Bank of America also launched their 2025 EPS at $2.75. Again, times that by roughly the forward 12-month PE. And that would put you at about almost 5,900 on the SPY, almost 600 for the SPY. Wow. I mean, for hell's sake, look at NVIDIA insiders. They have sold $287 million of NVIDIA stock over the past month. Take that out to the last 12 months, and they've sold almost $1 billion of NVIDIA. Not a single buyer of NVIDIA stock over the last 12 months. And let me be honest, I'm not bearish at all. I wouldn't say that. I think there's risks out there, but I'm not overly bearish. I'm not calling for a depression like I've heard some people say. I'm not even really calling for a recession. I think there's a higher chance than 100%. That we see a recession, right? Meaning that the markets out there are assigning 100% chance of a soft landing. I think the odds of that are less. Jamie Dimon thinks that's like 35% chance of a soft landing over the next year or two. And maybe I would say that's even like 50%. It's a coin toss whether or not we go into recession. I think once the tax money's really gone off the economy and most of that gets spent, which happens really over the next couple of months, then I think we'll start to get a little bit better of a picture of what maybe we can expect throughout the rest of 2024 and maybe into 2025. I just think there's no regard for risk management in this market. There is no regard for valuations. There is no pricing in of what if we do go into a recession? What if inflation is higher for longer? What if the Fed doesn't cut rates in 2024? Because hell, look at the inflation report we just got. Super core CPI is at 6.9%, 6.7% on a 3-month annualized basis. You got to see some progress there. The Fed might just rug pull you on March 20th. That's the point that I'm bearish on. Back in October, November of 2023, I was making the most bullish videos ever, and people hated that. I expect people are going to hate this video, but I'm not afraid to make this video. That's the difference. Now let's talk Tesla here briefly. What all of this means for Tesla. This option activity we've seen today from hedge funds and institutions, which was crazy bullish. And then I do want to discuss some of your larger upcoming catalysts. Catalysts we have for this week, catalysts that happened today, including the SoftBank ARM lockup expiration, and my thoughts around that specifically. And then your next big catalyst, which is Jerome Powell. And we'll try to do this as quickly as possible. Now, Tesla's option activity today, remarkably bullish. Picture perfect, looked fantastic. From hedge funds and institutions, you had 737 different trades, totaling $1.73 billion. That's a huge amount for Tesla, with a positive order value of 69%. Very, very bullish from hedge funds and institutions, which that's surprising considering Tesla stock ultimately ended up closing in the red. Now, what does all of this mean going ahead for Tesla? Okay, I think we are in a bubble in terms of expectations, some areas of the markets in terms of actual valuations, like semiconductors, Microsoft, even Apple. You know, those stocks have very, very elevated valuations. The way that Wall Street is justifying their valuations is they're saying Nvidia by 2027 or 2028 is going to have, and I'll make up a number here, $40 of EPS. That means it's trading at 20 times earnings today for 2027 or 2028. That's how you know you're in a bubble, when people have to try to justify valuations by extending out the time horizon. There's a lot of risk that goes along with time. We don't know what in the world the economy is going to look like next month, let alone 2 or 3 years from now, okay? That's how you know you're in a bubble. Now, again, semiconductors, parts of tech, I think those guys are in a bubble. Whereas if you actually look at the overall markets, I do think valuations are actually very cheap. Excluding the Magnificent Six, if you will, valuations for the S&P are low, like 15 times, right? Russell 2000's even cheaper than that. So I don't think categorizing the whole markets as a bubble is kind of a fair way to put things. I do think certain areas of the markets are very bubblicious, and those areas of the markets, they have the highest percentage of the weighting in the S&P and the NASDAQ. So when you're looking at those as the index for the market's performance, in which basically everyone does, then it's easy to say that maybe the S&P and the NASDAQ are in a little bit of a bubble. But I think it's mostly a bubble based on expectations. Sure, valuations are quite high. They should come down, and they likely will come down, but it's really expectations and the fact that there's no risk baked into our markets. Now, when does that ultimately change? Well, a couple different things could play out. You could continue to see hot inflation reports. Eventually, the markets will care about that. Just like, I mean, they cared when the report came out this morning, stocks sold off and then immediately ripped higher after everyone's like, it doesn't matter. It's not higher than last month. It's just high, right? Eventually, if you stay high, imagine 2 to 3 more months of 0.4% month over month, you're going to be looking at 6% inflation, right? Close to that. Almost 5% CPI over the course of the year. Eventually that will matter, but as of right now, it looks like CPI does not matter all too much. The Fed coming on March 20th, that's going to be a very big deal for the broader markets. The markets have went from pricing in 7 rate cuts in 2024 to start the year to now pricing in about 2 rate cuts, 2.5 rate cuts or so. So you've already seen a lot of progress there. But if the Fed does say they may not have to cut rates in 2024, if inflation does not show more progress, that could come as a little bit of a surprise. Now, there's also other catalysts that can happen that are uncertain. I think one big catalyst that could happen throughout 2024 is weaker economic activity. Think about 2022. Stocks sold off because the economy was weak. People thought we were heading into recession, not because the Fed was raising rates. I think people forget that. The markets did not sell off so much because the Fed was raising rates. It was because it was implied with an 80% probability at one point, according to Reuters, that we were going into recession. You don't usually want to be an owner of stocks when there's recession fears. Now, usually recession fears drive down stocks more than the actual recession does. Unless it's some kind of deep recession, typically recession fears are worse than the actual thing. Kind of like, the prescriptions worse than, the disease type of deal. That's kind of the situation as well. I do think a slowdown in the economy at some point in 2024, a bad miss on retail sales maybe coming this Thursday, could be bad news for the markets overall. A lot worse than some people would expect. Again, because we're pricing in inflation's coming down, the Fed's going to give us rate cuts, we have this soft landing. Anything that jeopardizes the soft landing thesis, I think that's what really gives you larger kind of broad market weakness from here. Now, as far as catalysts that happened today, the ARM SoftBank lockup expiration, I think looking at this on a one-day basis really doesn't make a whole lot of sense to me. You want to look at a specific event in a multi-day kind of way, right? SoftBank, yes, they now have the option to sell ARM. They could do that at any time. Just because maybe they didn't sell today, that doesn't mean that's not going to be a negative catalyst for semiconductors. You could wake up and ARM could be down 5 or 10%. You never really know. So you don't want to draw any conclusions based on the first day of a lockup expiration. Again, for anyone that does not know, SoftBank owns about 90% of ARM. So at any point, they could start to sell and be a big problem for other semiconductors. And clearly you can see algorithms control the markets. You don't control the markets. Wall Street doesn't control the markets. Hedge funds, institutions, they don't control the markets. The market makers and the quants, they are the guys that actually control the markets. Now, unfortunately, when it comes to Tesla, I think we're in a bit of a weird kind of position. Tesla is not really loved by the markets right now because it's not deemed an AI stock, even though it is the best pure play AI play out there. So I think what comes next is, if we get good news, good catalyst, Tesla's raising prices, something that happens that I can't forecast, that's great. And there's always going to be a potential chance that can happen any day the markets are trading, literally at any time. I think this kind of narrative of you want to be in big tech is probably going to be around until it is not anymore. Again, Nvidia is really the stock that is controlling the markets, so maybe the SoftBank ARM lockup expiration could cause some selling there, and that could put a damper on Nvidia. You never know what kind of downgrade's going to come out or something along those lines, so it's hard to speculate there, but I really don't think much is going to change for Tesla until something does change, whether it's the economic data coming out this week, which on Thursday you are going to get PPI as well as retail sales. Again, if the economy gets worse from here, Tesla stock is not going to like that. The markets are not going to like that. PPI, producer price index, producer price inflation, as I like to call it. If that rises more than expected, last month was 0.3%. You're expecting 0.3%. That's not going to be great as well. PPI tends to feed or have a high correlation to PCE, which is the metric the Fed really cares about. So I think you really want to be watching the data here. I do think the markets are prone for downside from here, if anything. We are butting up right at about 5,200, which is most banks' year-end price targets in between 5,100, 5,200. I mean, we're already hitting those price targets by the first half of March. So you've priced in a lot of good news. I don't think much changes for Tesla until, again, something does change. Whether the economy gets worse, that's going to be bad news. Or if the Fed is bullish coming on March 20th, that's going to be really good news for small and mid-cap stocks, and I would expect to see a sell-off in big tech. So yeah, I'm really expecting Tesla's going to be in between the 190, 165 level until something does break to the upside or to the downside. Again, that comes down to the economic data. That obviously CPI doesn't matter too much at this point. You would think CPI would have, but obviously it did not today. So economic data and the Fed, those are the things that really do matter. If the Fed makes it more important around CPI data, then maybe markets will say, oh crap, You know, last month was not great. If the Fed says, yeah, if we just don't see inflation continuing to go down, we're not going to start cutting rates, then maybe that does put a little bit more importance back again on the CPI report. In the meantime, you have Nvidia up about 1% here in after hours, going parabolic. Big level to be watching there is about 9:30. That's Thursday's high of the day. If you were to get rejected here and lose momentum, it would be around 9:30. If you break above 9:30 to the upside, you're likely going to new all-time highs for Nvidia. Let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you guys want to come trade with us live in real time. Every time we make trades, I send out alerts. Others send out their alerts as well. Check that out, link down below in the description of this video. And also join the X account. It is Michael Tyler over there. You guys have a fantastic rest of your day, and I will see you in the next one.